Cryptocurrencies are known for their extreme volatility, and where there's volatility, there's also a lot of room for profit or loss. You will almost certainly lose money if you invest based on what a celebrity tweets or what a self-proclaimed expert advises you to do. How do you prevent losses in crypto trading? How to ride the wave? Welcome back to the channel. In today's video, we will be showing you tips to consider during a market slump in order to protect your portfolio's value. Before we get into the video, don't forget to drop a like on this video and subscribe to the channel if you haven't already. Make sure that the post notifications are turned on so that you never miss a video from us. Without further ado, let's dive in. While keeping up with the latest news and developments in the cryptocurrency field is critical, having too much information can be counterproductive. This is especially true during market downturns when it's all too easy to let your emotions take over and make some bad trades. Fear of missing out, or FOMO, and FUD, also known as fear, uncertainty, and doubt, are well-known terms in the cryptocurrency industry, and they can have a bigger influence on our buying and selling decisions than many of us would like to admit. FUD refers to a poor market mood caused by a rumor, a negative news report, or a prominent figure voicing concerns about a specific market or asset. Traders selling their stocks in expectation of further price drops may have a negative effect on the price. FOMO stands for fear of missing out, and it relates to a trader's inclination to get carried away with wishful thinking when they witness positive market activity or news, sometimes overlooking basic indicators in their excitement to board the next rocket ship to the moon. Nobody can predict the future, and no one's advice is more useful than performing your own research and drawing your own conclusions. Influencers and publications may have a vested interest in creating FUD or FOMO in order to manipulate markets in a particular direction. Always seek confirmation from numerous sources when learning about the most recent developments in the Bitcoin markets. Regardless of how certain you are in a particular item, you should never invest more than you can afford to lose. The last thing anyone wants is to be locked on an emotional roller coaster as the portfolio's value steadily falls in the hopes of favorable price movement. Most smart investors opt to maintain a variety of assets for the long term, ranging from alternative cryptocurrencies to stock market index funds to diversify their portfolios. It's been said that cryptography never sleeps. Because cryptocurrency markets are known for their volatility, crypto investors should prepare ahead and establish their trading strategies as well as their entry and exit points if possible. Even if you had complete access to all relevant data, a black swan occurrence, hack, or tweet from a prominent figure might cause values to drop. This is why it's critical to prepare ahead and take precautions to limit your losses in the event of a rapid crash. Fixed tactics like dollar cost averaging, the process of purchasing or selling modest sums at regular intervals, could allow a crypto buyer to avoid trading with their emotions or having to stare at the charts 24 hours a day, 7 days a week. It's easy to get carried away when it comes to volatile investments like cryptocurrency. Trading is a high-risk activity, especially in a bear market, and investors should set goals that balance minimizing losses while maximizing gains. While the saying, "it's not a loss until it's sold," is only partially true, it has some merit. Unrealized losses occur when the worth of your assets has decreased since you purchased them, and they are only realized when they are sold for less than the purchase price. Over the long term, Bitcoin has continuously trended upwards. Even if prices are decreasing owing to a monetary market correction or a lengthy bear market, history teaches that due to economic causes like scarcity, prices will eventually recover. Many people assume that because of the limited supply, the price of cryptocurrencies such as Bitcoin will continue to grow over time. Negative price movement can be considered transient if your investment terms is years rather than weeks or months. With Bitcoin emerging as the most successful major asset of the last decade, the long-term holding has proven to be a profitable strategy. Countries such as the United States, Holding cryptocurrencies for extended periods of time might save money on taxes. Holding for a year or more, for example, may be preferable to selling in the short term. One of the best strategies to reduce crypto volatility and protect yourself during a market slump is to convert some of your volatile crypto holdings into more stable assets. History shows that market movements and patterns repeat themselves in cycles and that speculative bubbles and market crashes occur on a regular basis. Investors should avoid overthinking the market since it will go where it wants to go, and the best chance is to try to follow it. Because it is extremely difficult to catch all of the fluctuations, investors must always trade according to the current trend. Anyone who tries to do so risks losing a lot of money. Switch a portion of your portfolio to stable value assets, decreases your exposure to price volatility when markets are quiet, as stablecoins like USDC try to maintain their worth at a predetermined price. Keep in mind, though, that selling everything at once, a practice known as capitulation, can easily result in crypto holders losing money if the market recovers suddenly. Before you are forced to make a decision under stress, you should develop a preliminary estimate of how much profit and loss you are willing to accept. Many investors today opt to move in and out of solid assets as part of a bigger withdrawal and buyback plan, which, if done correctly, can help them gradually increase their portfolios. This isn't easy, and even the most seasoned investors frequently make mistakes when it comes to timing their entries and exits. Dollar cost averaging, once again, can be a useful approach for many investors to avoid even attempting to time the market. If you know where to look, even when the crypto prices are dropping, there are opportunities. While some see a dark and dreary crypto winter, others see a new window of opportunity to buy and profit from their favorite assets. Traders who felt priced out of recent gains can enter market or enhance the positions by buying the dip. Even in decline, the market will vary and there will be small peaks and valleys. Traders who brush up on the technical analysis skills will benefit from this since they will be able to predict these short-term shifts and profit by buying lows and selling highs. Short selling or betting on an asset's value falling can be a profitable strategy during market downturns. Even in a negative market or downtrend, activities like staking and DeFi yield farming can help level out returns and give support to ensure your actual crypto balance is always growing. Dollar cost averaging works whether markets are up or down if you believe an asset will eventually be worth more. During downturns, you actually receive more Bitcoin for your dollar. With the possible exception of DCA, these hobbies are not for the faint heart and may result in big losses or at the very least significantly increase the amount of time you spend in front of a screen watching price action. A drop in the cryptocurrency markets may make you nervous, but use it as a wake-up call to reconsider why you are in the market in the first place. What are the advantages and disadvantages? While Bitcoin, for example, has rebounded strongly after past significant drops, there's no assurance it will do so again, especially if it's facing real existential problems as countries ban its usage and possibly even ownership. And if the reality is less severe than the expectation, that's the kind of actual danger that can kill or profit an investment. With this, we have come to an end. The content in this video is for educational purposes only and hence should not be considered financial advice. All the financial decisions should be made after doing your wide spectrum research. Do let us know in the comment section below. Also, make sure that you like this video. Comment down your thoughts regarding this video and also do not forget to subscribe to our channel to stay updated about the latest videos. Until then,